Welcome back, VITA volunteers. In our last two lessons, we began talking about income from a variety of common different sources, including some sources of earned income like wages and unearned income like interest. Today, we're going to continue that discussion by talking about retirement income, which can include things like employer-sponsored retirement plans and pensions, as well as IRAs, which are individual retirement accounts, and annuities, which are sometimes a type of product, financial product that's offered by insurance companies. So when our clients come in, they're going to have this form 1099-R, which is going to report some form of retirement plan distribution. And we'll also note from our intake form, they will most likely, hopefully, have checked that they have on line 11, retirement income or payments from pensions, annuities, or an IRA. And if you notice, it lumps a whole bunch of kinds of income together. And that's really important in our interview process, that we are asking our clients, what type of plan were you contributing to? Where does this come from? It's really important for us to know that, because we need to know whether when they contributed to the plan, were those contributions before or after tax. It's really going to make quite a bit of difference in how much of this will be taxable. Let's talk about some of the types of plans we might be seeing. We might have an employer-sponsored sort of plan that would be like a pension or a 401k or a 403b, and these are plans where the employer made pre-tax contributions, or perhaps the employee, which is more common now, made pre-tax contributions through withholdings from their pay. So those contributions would have been made pre-tax. In an IRA, there's a couple of different kinds of IRAs, individual retirement accounts. They could be traditional or Roth. These are just tax-sheltered retirement savings plans, and instead of being set up by the employer, the taxpayer set them up separately, or they might have rolled over a 401k into an IRA. If it's a traditional IRA, generally speaking, those contributions were pre-tax. That's not always the case. So it's good to ask for a little further clarification. If you find out that it was a traditional IRA, just make sure were all of these contributions made pre-tax. For Roth IRA contributions, those are usually made after tax, post-tax. Some other types of plans are railroad benefits. There's a Tier 1 or a Tier 2 railroad benefit. Tier 1 is more like Social Security. So we won't be really covering what happens with Tier 1 in this lesson. In our next lesson that covers Social Security, just know that Tier 1 is treated like Social Security. Tier 2 is more like a pension plan from an employer, and so we would treat it that way. So that's reported not on a 1099-R, but it would be on a form RRB 1099-R, and that's usually a green form. Then there's also annuities can be reported on a form 1099-R, and these are just a series of payments under a contract from an insurance company or a trust company, or it could be an individual. And annuity payments are made at regular intervals over a period of time more than a full year. If you're an accounting student, you're probably getting familiar with what an annuity is. And if you're not an accounting student, then yeah, it's just a series of payments that are paid, and usually people purchase these from some form of an insurance company. Back to the idea of when was the money funded into the account? Was it a before tax contribution, or was it an after-tax contribution? And again, this matters because it tells us how much of this distribution, how much is being reported to the taxpayer, will need to be taxed, and is some of it able to be excluded from tax. If all of the contributions were made pre-tax, so think of, your 401k instance, then the taxpayer has what's called no cost basis. So the whole distribution would be taxable. However, if they had some kind of plan where they were making after-tax contributions, then that means that they did pay taxes on the money that they funded into that account. And so they are going to have some cost basis. And we would want to subtract out that cost basis, because otherwise that money is getting taxed twice. And for Roth IRAs, there's the little extra benefit that even their earnings don't get taxed. So just know that if it was some account that had after-tax contributions, they're at least going to probably have some cost basis. And it might be up to the entire distribution for a Roth IRA. Emphasizing again, the reason why we subtract the cost from the distributions is to avoid double taxation. Very often you will get a 1099-R, and it will tell you the amount of the distribution, and it will tell you the amount that is taxable. So they've already subtracted the cost basis for you. However, that's not always the case. Sometimes the taxable portion is not determined for a number of reasons, and sometimes there might need to be adjustments to that taxable portion. If that's the case, it's really important to note that advanced certification is required. You would need to do a little extra training on how to perform what's called the simplified method of calculating out how much of the distribution is taxable. So as long as the taxable distribution is determined and it's exactly as it's reported on the 1099-R, you can enter the form into TaxSlayer as a basic certified volunteer. But if there's any sort of calculations or things that need done around that, you would need to have advanced certification. So now I know you're wondering, how am I going to know when taxable amount is not determined? So when the client brings in their 1099-R, you might see in box 2A, which is for the taxable amount. Box 1 is the gross distribution, and then 2A is the taxable amount. It might be 0 or it might be blank, and there's going to be an amount shown in box 9B, which is your total employee contributions box. It could also be that box 1 and 2A have the same amount, and the taxable amount not determined box is marked, and that's in box 2B. So if that taxable amount not determined box is checked, then you know that the taxable amount is not determined. If it's not checked, and box 1 and 2A are filled in with the same amount, that just means that the whole distribution is indeed taxable. And then Form RRB 1099-R, which is our Tier 2 railroad benefits, those will always require a calculation to figure out the taxable amount. So again, for basic preparers, if somebody comes in with that RRB 1099-R form, then we either need to find volunteers that have the advanced certification, or we might need to refer them to the AARP program if we don't have enough people on site with the correct certification. And after that, here's a good visual of what boxes you'll be scanning for. So again, that 2A taxable amount might be 0 or empty. You look for 2B, is the taxable amount not determined checkbox checked, and then again in 9B there's your total employee contributions. So again, those would have been after-tax contributions that our taxpayer is going to want to subtract out of their gross distribution, of course. Another really important box to watch for on our Form 1099-R is box 7. In fact, it's so important that there's data validation in TaxSlayer that won't let you submit your entries from Form 1099-R until there is a value in this box. The reason why is these are distribution codes, and they tell us a lot about what happened and what are the circumstances around the amount being reported in box 1, the gross distribution. So you might have a code 1 for an early distribution with no known exception. And this is important because if that's the code, we're probably looking at not just having this be included in taxable income, but also an extra 10% penalty unless we can talk with our client and find that they did indeed have an exception that we can then report on the return. Code 2 is an early distribution where there is a known exception that applies. Usually they would have reported this to the trustee or the organization that is reporting this distribution. A code 3 in box 7 it refers to a disability, and this again is really important because ordinarily gross distribution from a retirement account is going to be unearned income. However, there are circumstances where if our taxpayer is disabled and the code is 3, that there's a checkbox on the input screen where this gross distribution can be moved to earned income, and it would show up on the 1040 and line 1 where the wages show up. And this helps them to use this to qualify for things like earned income tax credit. Code 4 is a death benefit. Code 7 is just a normal distribution. Somebody's reached the retirement age and now they're getting payments, and so you know, it might be fully taxable or partially taxable depending on whether they made pre-tax or post-tax contributions. Code G is a direct rollover of the distribution and a direct payment. So that's where they had a trustee-to-trustee transfer, and our taxpayer was never involved in this transfer. So this sort of thing happens like when you change jobs, and you know your one employer was using one trustee, and the new employer uses a new one, and you just want to roll those old funds into your new employer's account. You might see a code G. And so that's really important because, again, a person would not have reached retirement age, and without that code, they'd be looking at having to pay tax and pay a penalty. So we want to make sure that they aren't paying tax and aren't paying a penalty when that's not necessary. And code Q is for a qualified distribution from a Roth IRA. And if you'll remember, we talked about Roth IRAs are a little extra special because you make the contributions post-tax, so those definitely aren't taxable, but also the earnings aren't taxable. So code Q tells us that none of this gross distribution is going to be taxable. So again, if you see, for instance, like code 1 in box 7, we have, an early distribution. Code 2 refers to early distributions as well, but there was a known exception. So generally, if a distribution is taken before age 59 and a half, then our taxpayer is going to owe income tax on the early distribution. So if they took out, the whole amount in their plan, that could really increase their taxable income for the year. And then in addition to that, they're going to see an extra 10% penalty that's going to get added to that tax. And a lot of times when this happens, the trustee was required to withhold some of the distribution for tax. And so a lot of times our clients think, oh, well, they withheld the tax, they took the tax out. They don't realize how big the implications are when you take a sum of money out of a retirement account early. So this is kind of an area where you have to tread carefully. There's not really a whole lot we can do unless they did have an exception that qualifies them to not have the extra 10% penalty. They'll still owe the income tax. So if it was a large distribution, it can be pretty painful, and we have to deal with this sensitively. As we talked about a little bit before, there are direct rollovers where somebody would have, taken money out of one account, tax-favored account, and moved it into another tax-favored account. And so a couple of types of these transfers, these direct rollovers, you have the trustee to trustee, which we talked about is code G in box 7. And that again, the funds were transferred, the one trustee made the check out directly to the new trustee, and so our taxpayer never received these funds. They just went directly from one place to the other. However, there is also what's called a 60-day rollover, and because the taxpayer would have received these funds from the one trustee, that they would have requested the funds and the trustee would have made the check out to the taxpayer, there might be a code 1 which says, early distribution, no known exception. However, if our taxpayer deposited those funds into either the same account or a comparable account within 60 days, then we can make an adjustment. Again, you'll need to be advanced certified to do this, to box 2A, so that we're accurately reporting how much is taxable. Hopefully they put all of the money back in, and so it is all just smooth and tax-free. Sometimes they might not have put all of the money back in, and sometimes there's a little bit of a hitch where the first trustee withheld some money for tax, and sometimes that amount that they withheld, that was also supposed to make it into the new account, and sometimes our taxpayers didn't know that, and so they end up with a little portion that is taxable. But it's really important to just make sure that we're not causing people to have taxes and penalties when they are making these rollovers. And just a little bit more about that code 3 that indicates that this is a distribution to a taxpayer who is disabled. This is when the taxpayer is disabled before the minimum retirement age, and that's determined by the employer. That's what determines the retirement age for that. And as we talked about before, there's a little checkbox in the input screen for the 1099-R that allows you to count this as wages, and that allows our taxpayer to use this as earned income for the earned income tax credit. And then when our taxpayer does reach the minimum retirement age, the trustee will no longer report it as code 3, and it will just be reported as code 7. Clarifying again the differences between our two types of IRAs, our traditional versus our Roth IRA. The traditional was generally contributions made pre-tax, not always, so you always want to ask, are any of these contributions post-tax? The distribution will be either all or partially taxable, and hopefully this is a normal distribution and it's reported in box 7 as code 7 and not box 1, so we don't want to see any penalties, which is kind of miserable for everybody all around. And then again with our Roth, the contributions were made post-tax and the distributions are tax-free as long as there's certain requirements, like the taxpayer needs to have held the account for more than 5 years. that will be in box 7 and should be code Q. And there are going to be, in our skills check questions, a few questions that you're probably going to need to look up in your 4012 regarding some of the requirements and exceptions for a taxpayer who has what would otherwise be early distributions. We won't have time to cover them in our video, so it is something that you'll need to look up. But it's good because in tax we regularly have to look things up, and it's good to get used to doing that and realizing that that's not an indication that you don't know your stuff. That's just how tax is. We look stuff up. So another thing that's important to be aware of for our taxpayers is that their retirement accounts are not always required to withhold money for taxes as they go, the same way like an employer withholds, they're required to withhold money as you go for taxes. It's not the case here in most cases. And in a few cases, like with the early distributions, they might be. But that can leave our taxpayers open to owing, you know, a lot of money, and they may be expecting it. They may not be expecting it. If the taxpayer owes more than $1,000, they're definitely going to want to adjust their withholdings to avoid a penalty in the next year. So a couple of forms that they can use to do this. We have the form W4P, which is the withholding certificate for pensions and annuity payments. This is something that they fill out and they send to the trustee. They don't send it with the tax return. Remember, just like your employer collects your form W4 for withholdings, this is something that goes to the organization that is to be withholding the funds. So that would be the trustee. And we talked, I think, just briefly in our unemployment lesson that there's the ability to have voluntary withholdings. And so for government payments and unemployment compensation, there's a W4V that can be sent to whichever organization governmental organization they're dealing with there, to withhold funds from, you know, unemployment or Social Security. So it's important for our clients to just know that, you know, they are in charge of those withholdings, and if they want to withhold more or less, that's something that they can control by filling out these forms. Before we conclude, I just want to emphasize that, you know, in this area, there's a lot of scope limitations, so just be careful of scope. Remember that any adjustments to that taxable amount of the distribution in box 2A is going to require advanced certification. And there's also, if you do have advanced certification and you have learned how to calculate the taxable amount using the simplified method, then that's great and you'll be able to help with that. But there's another way to calculate the taxable amount, and that's with the general rule, and that's just out of scope for our program altogether. So it doesn't matter if they've been using the general rule to figure their taxable portion in the past, then their return is just going to be out of scope no matter what certification you have. And then always check in publication 4012 and tab D for any unfamiliar box 7 codes. There are more codes than what we covered today. We covered the main ones that are in scope for us, so there's some other codes that will be out of scope. So if you see anything in box 7 and you're like, can't remember what that is, look it up in the 4012 and just make sure that it's in scope before we start the return.